So how does Berkshire Hathaway work? Berkshire Hathaway is a holding company that has notable subsidiaries such as Geico Insurance and Dairy Queen. The company holds a considerable stock portfolio worth currently $348 billion in stock alone, excluding the cash. Berkshire owns considerable stakes in Apple, Bank of America, American Express, Coca-Cola, and other remarkable names. The company has been successful with its investments thanks to its impressive management team with Charlie Munger and Warren Buffett at the helm of the ship. Berkshire also invests heavily into energy, investing over $35 billion in renewable energy alone, and they plan to spend even more money in the future on renewable energy. Berkshire Hathaway is diversified across many industries and has a large cash pile of about $144 billion to make purchases if necessary. Essentially, their idea is that if a company comes up, they want to make sure that they have enough cash that they can essentially acquire the company if they really like it, or they could buy parts of it. So if the stock market were to crash, they could essentially buy back their own stock. They could buy out whole companies in the stock market as well for a very reasonable price. So the idea is they keep a large cash pile to reserve cash for those hard times. Berkshire Hathaway's market cap is around $778 billion, making it a large cap stock, and the company was founded in 1839. Just a note, Berkshire Hathaway was taken over by Buffett on May 10th of 1965. Now let's analyze the industry. There has been good growth in the American telecom industry, as we discussed in our AT&T video I recently uploaded, and this benefits Verizon, which Berkshire invests about $8.1 billion in, although they are still losing market share to AT&T. If you care to learn more about this, check out our long-term analysis on AT&T, which I'll link in the description below if you're interested. In terms of the oil and gas industry, there is significant projected growth for the industry. However, over the long term, I'm not sure if it remains to be the most profitable industry to invest in due to the ongoing switch to clean energy. Yet, that may still take many, many years in order to have a noticeable impact on the industry. However, EVs are certainly going to have an effect on oil and natural gas businesses in one way or another. Lastly, the banking industry should expect to grow in market size with a rising interest rate, and this includes the insurance industry as well. Both industries tend to benefit from rising interest rates, and with the Fed expected to bring the rate to near 2% from 0.25 to 0.5%, I think Berkshire Hathaway has the right idea with investing in these industries. Berkshire Hathaway's price to earnings is a relatively fair 9.79 compared to a Berkshire competitor, Markel, which trades at price to earnings of 8.66. Berkshire's price to earnings is slightly higher than Markel's, which is to me not concerning at this time. The Dow P currently is at about 18.2, while Berkshire trades at a much lower PE, and that can help suggest that there is an undervaluation of Berkshire on the stock market. Also, Berkshire Hathaway has a historically low price to earnings right now compared to its past P's, which are near about 12. However, we do have to understand that Berkshire Hathaway has made a lot of money recently due to selling shares and taking profit. So Berkshire Hathaway has made a lot of money in terms of net income. However, if the net income were to drop, which I expect it to, then this price to earnings would then jump significantly as the stock is currently up as a result of them making more money from net income. So the price to earnings looks really low currently, however there is still a considerable risk with this jumping at any time. And for the price to book, we seem to have a different situation. Berkshire Hathaway's price to book is low relative to other companies in this field. Currently, Berkshire has a price to book of 0.96, compared to Markel, which has a price to book of 1.46. Berkshire Hathaway currently has a lower PB. Berkshire has also a high PB relative to its past PBs near 0.7 and 0.8, which is a bit concerning. I also want to note that this is a low PB relative to the S&P 500 PB of 4.2 currently. However, this is near the PB of the S&P 500 during the dot-com boom. This can be good since Berkshire has a PB considerably lower than 4.2. Unfortunately, their PB still seems too high in my opinion. In terms of the intrinsic value, the company seems to offer an upside of 68% for their B shares due to the strong free cash flow. After projecting the next 10 years of discounted cash flows from the past 10 years of cash flows, with a perpetual growth rate of 2.5% and a discount rate of 9%, the company has an intrinsic value of $593.78 per share, relative to a recent closing price of $352.83 a share. Now, there are multiple ways to calculate the intrinsic value, and this is just one way. And at this time, since the company has a really high free cash flow after selling a lot of shares recently, I think this intrinsic value model may be too generous for Berkshire Hathaway, and I don't consider them to truly have an upside of 68% in my view. I also want to note the company's earnings, as their free cash flow, EBIT, and net income appear to be generally increasing over time due to increasing profitability over the past decade. This is due to profitable investments over the past decade from Berkshire and their management team. Berkshire Hathaway repurchases stock only when they deem their stock to be undervalued, which is a great way of repurchasing shares efficiently. When a company buys back their own stock, the book value increases and the intrinsic value increases as there are less outstanding shares in the market. However, this should only happen when the stock is believed to be undervalued, because the money can otherwise be reinvested back into the company for growth, research, and of course, acquisitions instead. Berkshire Hathaway doesn't currently pay a dividend, since the company thinks they can reinvest this capital and offer better shareholder returns as a result. So overall, what do we think about Berkshire Hathaway? Berkshire appears to be fair valued at the time of recording, in my opinion, due to a relatively fair price to book within the industry and a relatively fair price to earnings. The intrinsic value is considerably higher than the company's current trading value, which is great. However, I think the discounted cash flow model can overvalue Berkshire Hathaway due to recent high free cash flows. Over the long term, I expect the earnings of Berkshire Hathaway to gradually increase as they continue to grow as an investment business. My main concern, though, would be that Berkshire Hathaway is currently run by Warren Buffett and Charlie Munger, and they are both getting older, as Warren Buffett is currently of age 91, and Charlie Munger is currently 98. Unfortunately, if one of them were to pass, people may look at the company in a different light. This can change the company's management and investment strategy, which could lead to less than stellar management choices for Berkshire. Although their management may not be too different, as other investors have worked under Warren and Charlie for many years, and they have made numerous investment decisions for Berkshire, people may view the company as a completely different entity than what it used to be, and therefore this may be considered a risky investment to some people. Although this is sad,